You're watching a monetary system collapse in real time. January 24th, 2026. Silver trading at $102 per troy ounce on paper, gold approaching $5,000. These are not prices. These are symptoms of a terminal diagnosis that has already been delivered to the global financial architecture. What is unfolding right now is not a rally. It is not speculation. It is not a bull market. This is the moment when the illusion fractures and physical reality reasserts dominance over paper, promises that can no longer be honored. The most dangerous signal in financial markets is not panic. It is divergence. It is the moment when two prices for the same asset exist simultaneously in different locations, and the gap between them becomes so wide that arbitrage itself breaks down. That moment arrived on January 1st, 2026, when physical silver bullion in Tokyo and Dubai began trading at $130 per troy ounce, while COMEX futures in New York quoted $72. An 80% premium, not 5%, not 10%, 80%. Let that number settle into your understanding of what is actually happening. For the first time in modern market history, the price discovery mechanism for a globally traded commodity has fractured into two completely separate realities. One is the price of a promise. The other is the price of possession. This is not a temporary dislocation. This is a structural fracture that reveals the entire paper. Silver market has been operating as a leveraged fiction for decades. When Shanghai offers an $8 premium over COMEX prices to secure physical metal, when Indian buyers offer $5 above spot, when dealers across Asia cannot source inventory at any price, the message is unmistakable. The people who need actual silver, who require it for industrial production, or who understand its monetary function, have stopped believing in contracts. They are demanding metal, and there is not enough metal available to satisfy that demand at current quoted prices. Now we need to talk about what this divergence actually means for the system that has governed commodity pricing since the 1970s. For half a century, price discovery for silver occurred on the COMEX in New York and the London Bullion Market Association. These exchanges allowed participants to trade paper contracts representing silver at volumes that dwarfed the actual physical supply. At one point, the notional ratio of paper claims to actual above-ground silver reached 356 to 1. 356 contracts written against the same ounce of metal. The system functioned as long as everyone agreed to settle in cash or roll their positions forward. It functioned as long as the majority of participants never demanded delivery. It functioned as long as trust held. That trust is gone. Silver lease rates, the cost of borrowing physical silver for delivery, have exploded to 8%. Read that again. 8% annualized to borrow silver. The historical norm is between 0.3 and 0.5%. When lease rates spike to 8%, it means institutions are willing to pay nearly any cost to secure metal they must deliver against obligations they have already sold. It means the supply chain has seized. It means there are contracts outstanding that cannot be honored with physical metal. When you're paying 8% just to borrow silver temporarily, you are not operating in a functioning market. You're operating in a liquidity crisis where the underlying asset has become unavailable at the stated price. The COMEX registered inventories, the silver available for delivery against futures contracts, have collapsed by 70% since 2020, from 346 million ounces down to 82 million ounces. London Bullion Market Association vaults have lost 40% of their holdings. Shanghai inventories have fallen to decade lows. At current consumption rates, some regions have 30 to 45 days of accessible reserves. This is not a supply glut being managed through price discovery. This is a depletion event happening in plain sight while official prices lag the reality of scarcity by months or years. This brings us to the most dangerous signal of all. On December 26, 2025, the New York Federal Reserve delivered a $17 billion emergency cash injection to an unnamed bank. $17 billion. Emergency. Unnamed. While the world was watching fireworks and making resolutions, someone on Wall Street was begging for liquidity to cover a position that had gone catastrophically wrong. Then, between December 30th and January 1st, the Chicago Mercantile Exchange raised margin requirements on silver futures twice in 48 hours, twice in 2 days, during a holiday period when nobody was supposed to be watching. Margin hikes are the exchange's emergency brake when they detect systemic risk in the market structure itself. When they raise margins twice in 2 days, it means they see default risk. It means they see a player or multiple players who are short silver and cannot deliver. Here is what the data reveals. JP Morgan, historically one of the largest short sellers of silver futures, has reversed course entirely. The first delivery reports of 2026 show JP Morgan aggressively standing for maximum physical delivery. They are not rolling contracts forward. They are not settling in cash. They are taking metal, every ounce they can get. When the largest bank changes from short and hope for lower to take it all in physical, That is not a trade. That is survival. That is an institution recognizing that the game has changed and the only winning move is to hold the actual asset before everyone else figures it out. Now we need to understand why this is happening and why it is happening now. The answer is China. On January 1st, 2026, China implemented new export licensing requirements for refined silver. Only 44 firms were approved for 2026 through 2027. Each firm must demonstrate annual production capacity of at least 80 tons and meet state approval standards. This policy effectively ring-fences 60 to 70% of global refined silver supply for domestic use. China dominates silver refining not because they mine the most, but because they control the processing infrastructure. When China restricts exports, they are not limiting their own production. They are cutting off the rest of the world from the refined product necessary for industrial applications, solar panels, electric vehicles, artificial intelligence hardware, and electronics manufacturing. This is a strategic resource designation. Silver is no longer being treated as a commodity. It is being treated as a national security asset. And once one major power reclassifies a critical material, every other power must respond. The United States has already designated silver as a critical mineral. Saudi Arabia, India, and Russia are reportedly adding silver to strategic reserves, not for speculation, for sovereignty, for the recognition that in a world of currency debasement and supply chain fragmentation, the nations that control physical resources will dictate terms to those that hold only financial claims. This is where the system breaks. For 5 consecutive years, global silver demand has exceeded total supply. 5 years, not 5 months. The cumulative deficit from 2021 through 2025 totals 820 million ounces. That is nearly equivalent to an entire year of global mine production that has simply vanished from above-ground stockpiles. Where did it go? Into solar panels that will never be recycled, into electronics that end up in landfills, into the vaults of central banks and private holders who understand that the price they see on a screen bears no relationship to the cost of acquiring the physical metal. Industrial demand alone now consumes 600 million ounces annually, while total mine production sits around 820 million ounces. That leaves 220 million ounces for investment demand, jewelry, and monetary use. Except investment demand has been surging. Except central banks are buying. Except deficits have been running for 5 straight years. You cannot run structural deficits indefinitely. Eventually, the inventories drain to a level where price must adjust violently to ration remaining supply. We are at that moment. And the adjustment is not happening through the futures exchanges. It is happening in physical markets where real buyers are bypassing Western price mechanisms entirely and paying whatever premium is necessary to secure metal. The gold to silver ratio provides the final confirmation of systemic dysfunction. Gold currently trades near $5,000 per ounce. Silver trades near $100 per ounce. That is a ratio of roughly 50 ounces of silver to 1 ounce of gold. Historically, when both metals are mined, the ratio in the ground is approximately 8 to 1. During periods of sound monetary systems, the ratio averaged between 10 and 15 to 1. Ancient Rome established ratios between 8 and 12. Julius Caesar set it at 11.5 to 1. Throughout most of human monetary history, silver traded much closer to gold in value because both served the same monetary function. The divergence began when the world shifted to fiat currency systems after 1971. Gold became the preferred central bank reserve asset, while silver was relegated to industrial commodity status. But here is the contradiction embedded in the current market. If silver is simply an industrial commodity, why are central banks now buying it? If silver is simply an industrial commodity, why is China restricting exports? If silver is simply an industrial commodity, why are lease rates at 8%? The answer is that silver is being re-monetized in real time. The market is repricing silver, not just for its industrial scarcity, but for its monetary function in a world where fiat currencies are being debased at an accelerating rate. When gold hits $5,000 and the ratio compresses toward historical norms of 15 to 20 to 1, silver would trade between $250 and $330 per ounce. Not as speculation. As mathematical reversion to equilibrium based on multi-millennium monetary history. The current ratio of 50 to 1 exists only because paper markets have suppressed silver's price through leverage and derivative instruments that created the illusion of infinite supply. That illusion is dying. The physical markets in Asia are revealing the true price. And that true price is $130 in Tokyo and Dubai right now, not $100 on a screen in New York. This brings us to Bitcoin. While silver has surged 234% year over year, Bitcoin has collapsed 28% from its peak of $126,000 in October 2025. Currently trading near $89,000, Bitcoin has broken below key moving averages with $600 million in liquidations amid risk-off sentiment. Here's the question nobody wants to answer. If Bitcoin is digital gold, if Bitcoin is the ultimate store of value, if Bitcoin is the hedge against fiat currency debasement, why is it falling while gold and silver are exploding to all-time highs? The answer reveals the difference between narrative and reality. Bitcoin is a network. It is code. It is a distributed ledger secured by energy and mathematics. It has value as long as participants believe in that value and the network remains functional. But Bitcoin is not physical. You cannot hold it. You cannot touch it. You cannot use it in a solar panel or a semiconductor. It does not conduct electricity. It does not have 4,000 years of monetary history. When systemic stress enters the financial system, when counterparty risk becomes the dominant concern, capital does not flee to narratives. It flees to physical assets that have intrinsic utility and historical precedent as monetary instruments. The decline in Bitcoin while precious metals surge is not a contradiction. It is confirmation that we are entering a regime where digital claims are being rejected in favor of tangible resources. This is not about technology versus tradition. This is about possession versus promise. Bitcoin is a promise secured by cryptography. Silver is an atom. You can verify Bitcoin through mathematics. You can verify silver by holding it. In an environment where trust is collapsing across all institutions, from central banks to exchanges to governments, the asset you can hold and verify without relying on any external system becomes the ultimate form of certainty. The US dollar index provides another layer of this unfolding crisis. Trading between 98 and 99.5, the dollar has shown relative strength in early 2026 due to economic resilience and Federal Reserve policy. But here's the paradox. If the dollar is strong, why is gold hitting $5,000? If the dollar is strong, why is silver at $100? If the dollar is strong, why are commodities across the board surging to multi-decade highs? The answer is that dollar strength is being measured against other fiat currencies, all of which are being debased simultaneously. The dollar is not strong in absolute terms. It is merely the cleanest shirt in a pile of dirty laundry. When measured against real assets, against commodities, against things you can touch and use and store, the dollar has lost 80% of its value relative to gold over the past year. It has lost over 200% relative to silver. This is not dollar strength. This is currency failure measured against physical reality. The dollar may be appreciating against the euro or the yen, but it is collapsing against wheat, against copper, against energy, and most dramatically, against precious metals. What you are witnessing is the difference between nominal strength and real purchasing power. The dollar can rise on an index while simultaneously losing its ability to command real resources. That divergence is the definition of monetary illusion. President Trump's tariff threats have accelerated the safe haven flows into precious metals. 10 to 25% tariffs threatened against European nations over Greenland purchase opposition, ongoing trade tensions with China, and uncertainty around Federal Reserve independence have all contributed to the flight from financial assets into physical resources. But the tariffs are not the cause. They are the catalyst. The underlying cause is a global monetary system built on debt that can never be repaid, on promises that can never be honored, on leverage ratios that can only function in an environment of permanent growth and infinite trust. That environment is ending. Federal Reserve Chair Jerome Powell is now subject to a criminal investigation over headquarters renovations. Whether the charges have merit is irrelevant to market perception. What matters is that confidence in the Federal Reserve, already eroded by years of quantitative easing and zero interest rate policy and pandemic-era money printing, is facing another blow. When the central bank that issues the world's reserve currency is under investigation, when its independence is being questioned openly, when its credibility is being challenged at the highest levels of government, the consequence is predictable. Capital flees to assets that do not depend on central bank credibility. It flees to gold. It flees to silver. It flees to anything that exists outside the control and manipulation of monetary authorities, who have demonstrated repeatedly that they will sacrifice currency stability to maintain the illusion of solvency. What happens next is not a prediction. It is a mechanical outcome of forces already in motion. COMEX and LBMA face an intensifying squeeze as more participants demand physical delivery and inventories continue to drain. At some point, the exchanges will be forced to settle contracts in cash rather than metal. When that happens, when participants realize their futures contracts will not be honored with physical delivery, the paper price becomes meaningless. Price discovery shifts entirely to physical spot markets in Asia, where actual metal changes hands. New York and London lose control of global silver pricing entirely. just as they are losing control of gold pricing as central banks increasingly transact in bilateral agreements outside Western clearing systems. The gold-silver ratio will compress. It must compress. When silver is recognized not just as an industrial input, but as a monetary asset in a world of strategic competition and currency debasement, the ratio will revert toward historical norms. If gold reaches $6,000 and the ratio compresses to 20 to 1, silver trades at $300, not as a target, as an outcome. The numbers exist independent of belief. They are mathematical consequences of supply deficits, monetary debasement, and the re-monetization of silver by central banks and sovereign wealth funds who understand that the next global monetary system will be anchored in physical resources, not digital ledgers or paper promises. For those holding cash, time itself has become the enemy. Every day of delay is a day of purchasing power erosion. Every week of watching from the sidelines is a week where physical premiums widen and availability contracts. The settlement delays in silver markets have extended from 2 days to 2 weeks in some regions. When you cannot take delivery for 14 days, when dealers are quoting prices but cannot source inventory, when premiums above spot vary by 80% depending on geography, you are no longer operating in a market. You're operating in a scramble where price has become secondary to availability. This is the point of no return. We have crossed the threshold where the paper system governing silver and gold pricing for half a century has lost credibility in the physical markets that actually matter. The Chinese are paying premiums. The Japanese are paying premiums. The Arabs are paying premiums. They are paying these premiums because they understand that the metal they secure today may not be available tomorrow at any price. When refineries report backlogs extending months into the future, when mints suspend sales because they cannot source material, when institutional buyers are chartering flights to move metal across continents to capture arbitrage opportunities that should not exist in functioning markets, you are watching the end of an era. The era that is ending is the era of paper dominance. The era that is beginning is the era of physical scarcity. In the old system, derivatives controlled spot prices. In the new system, spot prices will be determined by physical delivery in markets where trust still exists. In the old system, central banks controlled monetary policy through interest rates and money printing. In the new system, central banks will be forced to respond to resource constraints they cannot print away. In the old system, financial engineering created the appearance of value. In the new system, value will be determined by what you can hold, what you can use, and what you can defend. This is not the final warning. The final warning was years ago when deficits began. This is the moment when those who understood the warning are being proven correct, while those who ignored it are learning that ignorance carries a cost, denominated in purchasing power, opportunity, and time. Silver is no longer available at any price because the price being quoted is a fiction. The real price is being revealed in Tokyo, in Dubai, in Shanghai, in any market where physical delivery still occurs and trust in paper has collapsed. That price is not $100. That price is not on a screen. That price is whatever it takes to secure the metal before the system fully breaks and physical delivery becomes impossible at any dollar amount. You are witnessing the transition from price to allocation, from market to scramble, from order to chaos. This is what the end of a monetary regime looks like from the inside. It does not arrive with announcements or declarations. It arrives with divergences, with premiums, with delivery failures, with exchanges changing rules in the middle of the night, with banks receiving emergency liquidity, with sovereign powers restricting exports of materials that were commodities yesterday but are strategic assets today. The system is not breaking tomorrow. The system broke on January 1st, 2026, when the price of silver became 2 different numbers in 2 different places, and the gap became too wide to ignore. Everything since then has been the aftershock, and the aftershock is still spreading.